Hello, everyone, and welcome to TradeStation. My name is Michael Burke, and I'll be the host for a few minutes here before we get started with our portfolio backtesting and trading with David Stendahl. This is the second in a four-part series that is looking at the principles and concepts of portfolio backtesting with our new tool, Portfolio Maestro. And David Stendahl was one of the original designers and was one of the original team members for Arena Systems that developed this product. And so he's the perfect person to go through the concepts of portfolio backtesting and the features and benefits of the Portfolio Maestro tool. So we'll get started with him in just a moment. For those of you who are new to our presentation, technology. If you have any trouble with the sound or the picture, you can refresh, or you can log out and log back in. That will help you as well. Gerald, I see your question. Why does it say part one? Because really the first session was an introductory session, and now we're into the three-part, David's main three-part course. So it's a little confusing, I granted, but David and I thought that was the best way to approach this, so that's why. This is actually part one of the portfolio backtesting series. The first piece was an introduction. That first piece, by the way, is on our website, and you can view that. If you missed that one, you can always go back and view that, and you definitely want to make sure that you sign up for the next two in this series as well. Keep in mind that all of the ideas and symbols used in this presentation are for educational purposes only. No recommendations are implied. Active trading is not suitable for everyone. Please make sure that you read the disclosure information on the TradeStation website or here in the PDF disclosure document that I'm going to push into the chat window. So without further ado, I'm going to turn it over to David, and we'll get started. Thank you very much, everybody, for attending. There's lots of great events coming up over the next couple of months, so definitely check the website and sign up for the events that are appropriate to your trading, and there's lots of great material coming, so definitely keep an eye on the events that we have coming up. So David, it's all yours.
All right, thank you, Mike. I appreciate it. Hopefully everyone can hear me okay. Just to clarify then, what we are going to do is a total of 4 webinars. The first one was kind of a primer just to kind of show how to use the program, some of the basics. I'm going to continue to show that in the next few webinars as well, but we thought that it would probably be most efficient to kind of show the ins and outs and how to do some of the basic things in the very first one. Then in this particular webinar, I'm going to talk a little bit about Portfolio Maestro. But the first step is trying to figure out what kind of markets to trade, why are we going to try to diversify, and try to give some background. And then the tail end of the presentation, I'm going to go into some of the charts that you see inside of Maestro. I guess technically the third and the fourth webinar that we'll be doing, technically part 2 and 3, we're going to go into a lot more detail and get into a lot of the specifics. First one, or the next one I should say, is going to really focus on portfolio metrics and the construction of the portfolio itself. And then the final one will start to take that same portfolio and start to apply a lot of different types of money management type strategies to it. So Portfolio Maestro is actually a very powerful program. And what we want to do is, see if I can turn my sound up a little bit, is to go through the steps of making sure that you fully understand what Maestro can do for you and understand the importance of what the program is technically all about. So let's get right into it. First chart is our disclaimer, and the disclaimer is there for the purposes of just making sure that you don't hold myself and or TradeStation accountable. But I think that take a look at that and make sure you feel comfortable with it. Now, let's talk about what's going to be in this presentation. We have about an hour or so to get into the material, and what we're going to be doing is putting it into 2 different steps. Step 1 is let's identify some markets that we want to trade. I'm going to show you some charts that are available on the Capitalogix website. You can easily do some of the same things inside of TradeStation, but every week, because I do trade, I'm always looking at a lot of correlation type matrices, and what I'm trying to do is to understand what is happening between all the different combinations. So I'm going to show you some of these correlation studies. I'm going to hopefully be able to validate and prove why it is that we're going to want to diversify a portfolio. So you're going to hear the word diversification an awful lot in this presentation. And when you really think about it, Portfolio Maestro is there to combine things together for the purposes of making the portfolio stronger, and by diversifying across markets and trading styles and trading timeframes. So we'll get into some of the particulars on that side. Then what we're going to do is we're going to review some key metrics in the performance of the actual portfolio. And we'll get into even more detail in the next presentation on that side. And then the tail end of the presentation, after you have a really good feel for it, what we'll be doing is going through and going into designing a couple of the different markets, the different individual portfolios, what I call a basket, and then combining those basket or mini portfolios together within the confines of a larger portfolio. So a lot of material. I'm going to take some questions when I can. I'll also see if I can leave a little bit of time at the tail end of the presentation, or I did put at the very top of the little window my contact information. You can contact me after, and I have the same information at the tail end of the presentation. So just so you understand, I trade futures. Everything I'm going to talk about is from the future side. You can and feel comfortable that what we're going to be doing is we're going to be talking on the future side, but you can equally do the same stuff in the stock side. So if I talk about the I don't know, 10-year notes, you can do it in an ETF. You can do it with any type of a stock. It doesn't make any difference. It all falls together. It's all the same basic premise that we're going to be working from. So some of the markets that I've traded as a CTA always stem from always trying to look at what will give me the greatest amount of diversification based upon my systems and the way that the actual markets trade. So trade equities, interest rates, energies, metals, currencies, grains, and meats. We can also do some of the softs and some other types of markets, but I'm going to be focused just on a few of these types of markets and kind of show you a smattering of what we can do. Now I'm going to be talking about correlation. I know it's boring. I know it's not the most exciting thing, but it is important so that when you start saying, I want to trade this market and I want to trade that market, this stock and that stock, what you want to do is you want to make sure that you're not trading the same market. Trade the S&P, the Dow Jones, the NASDAQ. They're essentially the same market. On my Twitter feed, I am constantly bombarding people with the fact that those three markets in particular are highly correlated. And what I mean by highly correlated, just for the basics, if you have a correlation of 1, that means they're working in lockstep. They're virtually the same. They are the same. If you have a -1, then they're moving in opposite directions. And what we want to focus on is near zero or negative correlation. Second thing is that a lot of people often will look at price action and do a correlation between two different markets, the actual closing price, if you will. What we do, and it's more accurate, and we'll get into the details, but it's more accurate to do it in a percentage mode. I was up 2% versus 3%. I was up 2% versus -5%, whatever the case is. Don't look at price, look at percent change. Having said that, what we want to do is take a look at a correlation chart. In this particular instance, it's the S&P versus the euro. Euro is a market that we trade. We happen to be short right now. Now, the correlation chart, this is one that I do inside of Excel, but you can easily do this inside of TradeStation as well. What you're doing is you're taking percent change on in this case, a month-to-month basis. This is a 24-month rolling correlation. And what we're trying to do is to determine, are the two markets, in this case S&P and Euro, are they highly correlated? And the dark blue line is the actual 24-month rolling correlation. The lighter blue lines are what is considered to be a high correlation and a low correlation. You will hear people say that a correlation greater than, I'll throw an example, of 0.8 is considered a high correlation. Things change all the time. So when you look at this correlation on the screen right now, that dark blue line, That's a 24-month correlation, and it shifts forward like a moving average, if you will. And you can see from that that the correlation adjusts constantly. So first thing with this chart, realize that correlations are forever adjusting. You can see that we have, at the time that I put this together back in early May, that the correlation was quite high, and it had been high for quite some time. Not only is it high on the chart relative to certain parts in the past, but it also is above and been in and around the upper lighter blue line. And what that tells you is that there's a high correlation between the two markets. It's in the lower portion of the chart. I'm not sure if you can see my cursor, but at the bottom, the correlation is 0.72. Now, it's not 0.8, which is what some people might look for in a correlation, but the correlation is high. And what I'm always trying to do is, if I'm going to introduce a market into my particular portfolio, into my arsenal of tradings, I want to make sure of making sure that we're also looking at how this thing adjusts all the time. And what we want to do is we want to make sure that as we look at this correlation, that you realize that this correlation is forever adjusting now relative to some of the other markets that you're going to be trading. So you're essentially building something off of a base market, call it the S&P 500. What additional markets can I put into my mixture that are going to offer up the best quality markets to actually trade from? Now, to give you some perspective, here is another chart, S&P against the 10-year notes. What I want you to notice is that it's a low correlation right now. It's in the lower portion. The correlation at the bottom of the screen says negative 0.58. And you can also see that it kind of meanders in around the zero level, which is that yellow, around that yellow line. It got moved a little bit when we brought this in. The yellow line should be up a little bit at the zero mark. But suffice to say that it goes up and touches the zero mark, and then has been meandering down for quite some time. I show this so you have a reference point between what is considered to be a high correlation and a low correlation. Further, here is crude oil. Crude oil, what we're doing is looking at something that is very similar to the euro as of late. It's a little bit different, but what you're seeing is that the correlation again is high, but it's not considered to be at a high level. The high level on this chart for crude oil is 0.81, while the actual correlation is at 0.73. And what we're trying to do is just make the reference point that so far we've seen three markets. Two are high, one is in the mid-range or actually low range. And you can see that there's a dramatic difference in how the correlation adjusts over time. This will make more sense in just a second. The final market that we're going to be looking at is gold, and that again has been meandering above and below the zero mark, and has one of the better correlations because of the fact that it is truly near zero. It's not necessarily way below, not way above. It's been meandering in and above. So gold is historically a very good market to trade. You hear it all the time that gold's a good hedge. It's this, it's that. Part of the reason is because it has a good low or near zero correlation against that of the S&P 500. Now, just to summarize here, just to get some perspective, we got two highs. We got the euro and the crude oil, which have a high correlation. We've got the 10-year notes, which has a low correlation. As I said, gold has a near zero correlation. This back against the individual S&P 500 market. This is important because when you want to build a portfolio, if you put, as they say, all of your eggs in one basket, all the markets react exactly the same way. You look at the top top stocks in the S&P 500, how they correlate to one another, or the example I gave earlier, Dow Jones, S&P, and NASDAQ. They're all going to react in the similar fashion. If you're going to diversify, at least start looking at some other foreign type markets. Start looking at some other interest rate type markets, but do something so that you're not putting all of your eggs into a single basket and you're trading virtually the same market. they all work in the same fashion. They all go up together, they all come down together. This is something that is pretty key to a diversified portfolio, and it's something that we've all heard, I'm sure, many, many, many times. But the reality is that I'm going to go through this presentation and kind of validate why you do that, because what I don't want you to do is, as I mentioned in my previous seminar last week, is don't be a one-trick pony and simply trade a single market with a single type of trading style and a single time frame. What you want to do is do the best that you can to continually diversify. So in a very simple fashion, all we're doing here is selecting the individual markets. We've got 4 from this list, obviously the S&P being included as well, so you have a total of 5. And what we're trying to do is to validate and prove throughout this presentation why that's important. And that will make more sense when we start to build a portfolio. You can't build a portfolio that's diversified by simply looking at NASDAQ, S&P, and Dow Jones. You need these other markets to be able to get that qualification, that diversification that we're actually looking for. Now, this is a little bit fuzzy, at least it is on my screen, but what I've done is I've highlighted the markets. What this is showing is the S&P 500 against 40 separate individual futures markets. We've got the currencies, we've got the stock indices, we've got the energies, and so forth. A lot of different markets that you would want to trade. And what this is doing is it is looking at the stability, the correlation stability between a market, in this case the S&P, against all of the other markets. Now, what's basically happening here is that the number, the correlation, the market S&P against the euro, we said was, I think, 0.72. And we saw on that previous graph that it fluctuates all the time. What we're looking for is the fluctuation. Is it stable or is it erratic? Does it jump from a high level, a high number to a low number and all over the place? Or is it going to be something that's relatively stable? I pointed out in the previous chart that gold meandered in around 0. And you can see in the far right, the red, the symbol for gold is GC. It's the 5th one from the right-hand side. That low number, that red bar, that gives you an indication that something is extremely low. And what we want are those types of markets that have a near 0 correlation and that have a stable near 0 correlation. So if we kind of pass through, you can see LH. LH again has a very low thing. It's yellow. It's the 1-2 from gold. LH is lean hogs. Further in the middle area, you see NG. It's right next to CL, which is crude oil. NG is natural gas. What you're looking for are those types of markets that, again, have a good low correlation stability. So the 5 markets that we're going to be trading, S&P being 1, we've got CU, which is euro, which is the first red one. It's not high, it's not low, but it's, it's in the mid-range. You got the 10 years, which the stability is actually, all over the place to a degree. It's not as stable as some of the others. We've got crude oil, and then we've got gold. This chart I update every single week for each and every market that I trade. And what we're doing is we're looking for that market and how it relates historically to all of the other markets. So if ever you want to see it, you can just simply go up to the Capitalogix website, just look for the correlation stability, and you will see this chart for any market that we happen to trade. And there's 40 of them that we track. So it should be sufficient for most purposes. But point is that we're not just looking at correlation, we're looking at it on a historic basis, as the previous chart showed. And then what we do is we use this correlation stability to really quantify just how stable a particular portfolio can be. So I've kind of said this to death here, but the 5 markets I said that we were going to look at are S&P, Euro, 10 years, crude oil, and gold. We could have thrown in natural gas. We could have thrown in lean hogs, but I think most people would feel more comfortable with the knowledge that the portfolio we're putting together in this particular presentation are in generic or well-established markets. Not to say that hogs and natural gas are not stable markets, but I think most people are more familiar with these particular markets, hence the reason that I selected them. So what I'm going to do is I'm going to show you the efficient frontier that I'm sure most of you have seen to one degree or another, and I'm going to go through a particular point and try to express numerically. Everyone always hears you need to be diversified. You need, you need, you need. Don't put all your eggs in one basket. It's cliche. Everyone uses it. I use it all the time myself. But the reality is that I want to go through the numbers to validate and prove it based upon these markets, and hopefully we'll show you a little bit more. Yes, volatility is to a degree a measurement of the correlation stability, how volatile it is and how stable it is. The smaller the number, the more stable it is. So just a good way to go through that particular process. Yes, we'll get to Portfolio Maestro. First, what we're doing is we're setting up what markets are we going to put into it so that we establish the most diversified portfolio. You jump right to Portfolio Maestro, you start throwing numbers around, well, sometimes you get a mishmash of different things. Logically, select the right markets, which is what we're talking about here, and then use Portfolio Maestro. Understand what we're building so that you know what's going to be good, as opposed to just throwing numbers inside of a program and expecting the world to be perfect. So the efficient frontier, all we're doing here is we've got 2 points, and it's hard to read on the screen, but if we look at the last 36 months for those 5 markets, S&P 10 years, gold, euro, and crude oil, and you mishmash them all together, just the markets, no systems, what you're going to get is an allocation of 22% for the S&P, 52% for the 10 years, a small smattering for 1% for gold, 22% for the euro, and a small smattering for the crude oil, call it 2.5%. That would have made the most efficient portfolio, the one that makes the most money relative to risk, and that is the red dot. We could also look at the efficient frontier, which is kind of the yellow dot, and that is the minimum viable portfolio. And so what we're trying to do is to find that one that is going to maximize return relative to risk. And this will all make sense as we start looking at some of the numbers that are generated from this. But suffice to say, there's formulas that we can use to figure out what markets we want to work with. Having said that, the portfolio over the last 36 months would have been heavily weighted towards the, in this case, the 10-year notes, which had a heavy weighting within the portfolio, and its compounded annual growth rate, called CAGR, compounded annual growth rate, was at 8.15% over the 36-month period. You can see from this that the first one, the S&P, was up 14.88. And we're going to do some comparisons between a portfolio and the S&P 500, but realize that the portfolio mixture is going to be changing, and this is nothing more than just a snapshot in time at a 36-month period. So today, back 36 months, this is what would have, and I phrase that correctly, would have given you the most stable portfolio. Now, would have doesn't help me because I need to know what we're doing into the future, and this will make sense when we do the walk forward. But suffice to say that had you used this particular portfolio mixture, that pie chart that we just looked at, from start to finish, your compounded annual growth rate would have been 8.3%. And you would say to yourself, well, that's all well and good, Dave, but if I just simply traded the S&P, 100% of my portfolio in the S&P, I would have made 14.88%. And I would say, yes, you are correct. However, return is but one measure of your portfolio. It is not the only measure. How much money you make is important. Equally important is how you make the money. So I would ask, in these presentations, how many people would take the portfolio that makes 8.3 versus the one that makes 14.88? And majority of the people are going to say, I'll take the one that makes 14.88%. Well, let's not look at just returns. Let's look at some risk metrics. Maximum drawdown, UMI, which is underwater mass index, R squared, Sharpe, Sortino, and Kalmar. If you look at the portfolio, what I'm suggesting, you're looking at, again, the CAGR of 8.3 and a maximum drawdown of basically 1% versus the S&P 500, which was, we'll just call it 15% on the CAGR, but a 16.5, I'll be nice, 16.5 drawdown. Well, all of a sudden now we're talking about real numbers here. It takes as much risk, in fact, there's more risk according to maximum drawdown versus our CAGR, and therefore you would say on a MAR ratio, which is nothing but dividing the two, that you would say there's more risk than reward. But the portfolio that I'm suggesting, quote unquote, the diversified portfolio, you're looking at one that has a ratio that's working in your favor. The more reward, less risk. I'm not going to get into the UMI in any great detail because it would take too long, but I have an article on the website called Underwater Mass Index, and it'll explain that particular index in a little more detail. I'm going to speed up the process because we're running out of time. But the UMI between the two portfolios, that is nothing more than just another measure. The lower the number, similar to drawdown, the better it is. So when you compare the two portfolios, the UMI, Underwater Mass Index, is actually less for the portfolio, no surprise, than it would be for the individual market. R squared shows the stability of the actual equity curve itself. The portfolio is more stable, less erratic than is the S&P 500. So all of a sudden, the 15% return of the S&P 500, although attractive on the surface, all of a sudden starts to fall apart a little bit when you start looking at some risk metrics. Similar, some of the ratios that you'll hopefully become familiar with. Sharpe ratio, better for the portfolio. Sortino, better for the portfolio, and same too with Calmar. They all start to look at risk metrics a little bit differently than we would have specifically in the 100% allocation towards the S&P 500. So the point being is that what we want to do is we want to make sure that the portfolio itself is not just simply measured based upon return. We want to factor in some of the different types of risk rewards. Maximum drawdown, that is peak to valley percent loss. Highest point to the lowest point, what was the percent loss? UMI is underwater mass index. I'll show you an underwater equity curve later in the presentation, but what that does is it sums up the amount of time that you're losing money. Magnitude and duration of drawdown. R squared is just a formula that looks at the stability of a line. The more erratic it is, the lower the number, the more stable it is, like a perfect 45-degree angle, the higher the number. So what we're looking for in some of these numbers, R squared in particular, is the higher the number, the more stable the equity curve. So here is the portfolio. You can see that it's very stable. You can see the yellow line for the actual S&P 500, that there is an erratic nature to it, and therefore it has a lower R squared. So I went out of my way to say that had you used this particular portfolio for the last 36 months, this is what your returns would have been. I'm sure some of you caught on that I didn't know that. So it's great in theory, Dave, but that doesn't help me in the real world. All right. So what we're going to do is we're going to use 12 months worth of data. You can see at the top here, the 12 months worth of data in the yellow. And then what we're going to do is we're going to use that same efficient frontier calculation. And what we're going to do is we're going to use those settings for the next quarter. So everything is real time. So we use 12 months worth of data, figure out the allocation, and we're going to use that allocation for the next quarter, the next three months. Then at the end of that period of time, I'm going to go back. I'm going to look at the previous 12 months, realizing obviously we've forwarded by 3 months, so we're going to have some redundancy of the data. But what we're doing is we're always looking at 12 months of data, and we're always using that allocation, and then we're going to use that allocation for the next quarter. And if we go through that particular process of always looking at that 12-month and a quarter's worth of information, and we sum up all of the out of sample quarters, and therefore get an accumulation of 36 months worth of data, I think you'll be surprised by what you see. What we're going to do is look at the allocations then of those individual settings for each of those quarters. And this is real data. So that little pie chart you see there, that is the allocation of those 5 markets. And you see from quarter to quarter to quarter to quarter, all the way through, at least the 5 that I'm showing here, that it does adjust in certain cases dramatically, in other cases in a very minimal way. But it does adjust itself, so therefore it's dynamic. And what you'll see is that we're able to come up with something that is real world. So it's not, had you done this, it's what you did do. So hopefully this is making sense, because it's very critical that you understand. So what we have now on the screen are the original portfolio, the 8.3%. You will find with the walk forward that the performance degrades because it's no longer the perfect fit, it is a fit, and it's as close to the fit as we can get in the real world. And so the CAGR does go down. It goes down to 7.25%, I'll say. You'll see that the drawdown and some of the risk metrics, in fact, all of them will actually degrade a little bit because, again, we're talking the real world and adjustments. But what I also want to point out is that relative to the perfect portfolio, things degrade. But the walk forward portfolio relative to the S&P 500, it's still quite good. And so what we have is a CAGR of 7.28, I'll call it 7.25% versus the 14. Again, it's less money. How you make the money, though, it's more important. So the drawdown, the peak to valley drawdown over that 36-month period is 3%. That's doable versus 16.5% drawdown for the S&P 500. The UMI is 15.27. It can be hard to reference that, but that's actually a really good number relative to the S&P 500. The R squared, the stability of the equity curve, it does degrade a little bit, but not that much. You're still talking about a really stable equity curve relative to the S&P 500, and the same can be said here for the Sharpe, Sortino, and Kalmar. So along those lines, you're going to find that the portfolio actually does get better. Now, I'm just going to go back here for a second, and what I want to do is take a look at this chart. This is the 36 monthly VAMI, Value Added Monthly Index comparison. It's just an easy way to compare 2 different markets or a market against a portfolio. And what I did is I went back to early part of 09. If you look on the screen and you take a look at things, you're going to find that if you go back to early 09, in this case it went through mid-May, and from mid-May to where we are right now, it's even higher as far as the S&P 500 goes. But if you went back to 09 to where I completed this particular presentation, you're going to find that that was probably cherry-picked. It was a really good time to be a really smart investor to go all in on the S&P 500. So I deliberately put this in the favor of the S&P 500 so I can make this point. If we were, and I'm going to shift forward here, if having looked at this over a 36-month period with my walk forward presentation, now you really get a feel for what happens. What if I did my allocation over 48 months? So it's still the same process that we go through, but instead of just having 36 months of data back from 09 to mid-May of 2012, what if we were to go back and add an additional year in the beginning? Now, all of a sudden, we're talking about something that's a little bit different. Yes, the portfolio degrades between the perfect scenario over 48 months versus the walk forward, where I said that you're always going to find that the performance numbers in the walk forward always degrade because they're a little more realistic. But if you really look at the S&P 500 over that same time frame, now all of a sudden you're losing money. The reason you want, WF stands for walk forward, not weighted factor. The reason that you want to not put all of your money into the S&P 500 is that you can always find a person. You may even do it yourself. You can always cherry pick the very best start to end period and say, I don't need diversification. Truth be told, you do. And this particular information, this process that I'm describing to you, selecting the right markets to put into the portfolio because they have stable correlations, near zero if at all possible, and they work well together over time. And then you do the walk forward analyses. What you'll find is that the performance of the portfolio is always superior to that of the S&P 500. If for any reason it's not, you'll find that when you start looking at risk metrics, again, max drawdown, UMI, R squared, and all the things that we've been looking at, in each of those cases, you always find that the performance numbers, the risk metrics are better. So suffice to say that when you add an additional 12-month period, going from 36 to 48 months, that all of a sudden the S&P doesn't look quite as good. When you look at it even further, over 60 months, the return even degrades even further for the S&P 500 versus the walk forward for the actual walk forward portfolio. So the numbers, for the most part, are always going to be superior. There will be periods where the S&P is the perfect market, and if you knew that, you'd invest all of your money, you would leverage the hilt, and you would go ahead and trade the futures and the options and take full advantage of that. But if we all knew that, then we'd all be geniuses, and we're not. I'm not that smart, so therefore I have to diversify myself across all of these different markets. So hopefully I've made the point that diversification is important. We hopefully all knew that, but it's always good to run the numbers so that you can see it, not just in a hypothetical, this period to this period, but also to be able to do that walk forward so you can see in a practical, real world, honest to goodness process that it is better to diversify yourself so you're not putting all of your money into a single market or a market that is very similar to other markets. Again, I keep coming back to the S&P, the Dow Jones, and the NASDAQ. They're all virtually the same. Their correlations over 12 months, 24, 36, 48, 60 months, they're all virtually identical. Someone that says that they're diversified because they have those three indices, you're not diversified. You have essentially the same instrument. And so what you want are these different instruments that are going to come together to really honestly give you the diversification. So having said that, first step is find these markets as I described. Second step is, in this video presentation, is to diversify an individual trading strategy against the individual market. This is where Portfolio Maestro starts to come into play. And what we want to do is diversify similar to having additional markets. You want to have trend-based, you want to have momentum-based, you want to have pattern-based, not price, but pattern-based type systems, and be able to put all of those things together so you have a diversified trading strategies against the individual markets. And the beauty of what Portfolio Maestro can do, and essentially what it's really all about, is taking all of those systems applied to the different markets. In this case, it's just for the S&P 500. And what I want to do is I want to not go immediately to the end result of the portfolio because you miss the details. So what we're doing here is we're building a mini portfolio, what I call a basket. I've got multiple systems that are looking for different conditions, each of which is trading against the S&P 500. And what we have is a VAMI chart. Again, it is a value added monthly index. That's what VAMI stands for. And this is a chart that comes directly from Portfolio Maestro. So to the numbers. So what we have here is a basket that is applied to the S&P 500, and the CAGR is 73%, and the CalMAR, as an example, is 5. Now, we're obviously looking at these 5 different markets. What we'll do is look at the S&P, and then we'll look at its risk. What I want to point out here is the underwater equity chart that comes obviously within Portfolio Maestro. And what you're doing is you're looking at pain and risk. This is one of my favorite charts. So the red signifies anytime you have a new high in your trading, and then all of a sudden you start losing money on a percentage basis, that's when the red is going to start to show. Think of it as blood, if you will. And the degree that it falls and the longer you're in it, you're going to find that there's more pain and suffering. So for the underwater equity chart for the S&P 500, the maximum drawdown is 14.6. Actually, the maximum drawdown is 14.65, and I've highlighted as number 1. You can see that we had some other drawdowns in 2011, and when I created this particular presentation, the current drawdown at that time was 8%, 8.5%. This will be important because when we start combining the individual baskets together, what our intention is, what markets are going to allow me to diversify my holdings and be able to minimize my drawdowns by adding non-diversified or non-correlated type markets. Here is a VAMI chart again. In this case, it's for the euro, and you can see that it has a really nice steady equity curve in the early stages. Then it goes flat, and then there's another surge, and then there's flat again. The underwater equity curve, it's the same makeup. The black lines represent new highs. Once you have a new high, there's a subsequent low. How much money do you lose? And what I've done is I've highlighted the blue line, or excuse me, the green line, and we had a drawdown of call it 10%, almost equivalent to 10%. The drawdown that's underway right now is around 9%. And what's interesting about this, if you saw the previous chart, the previous underwater equity chart, that the drawdowns occurred in different spots. So as one does poorly, the other one does well. When the other one does poorly, the other one does well. So there's propping up for the different markets based upon the different styles of trade. Moving this forward, what we have here is a VAMI chart for crude oil. Again, really good return numbers. The CalMAR is 1.1, but we have, without a doubt, a slightly different makeup. It still start to finish does well, but how it makes its money is a little bit different. And here is the underwater equity curve for CalMAR is like a Sharpe type ratio. But in this case, the crude oil, the drawdown occurs in the early stages, and it's fairly dramatic. It's around, well, 45%, and the current drawdown is 20%. That's bigger than some of the other ones we've actually seen. But by combining these markets together, and that's what we'll do here by looking at the individual baskets or mini portfolios, we'll be combining everything together, and this is the strength to what Portfolio Maestro is all about. 10-year notes, similar type nature. Here is the underwater. Again, the drawdown, not substantial, 13.5%, and the current drawdown is, we'll call it 2%. Final market is gold. Here is the underwater. It was steady all the way through until the early part of 2012, and what we have is a pretty substantial drawdown. It's the current and the maximum, both at the same time. They're each, we'll just call it 24%. Now what we want to do is look at the equity curve for the entire portfolio. And what we want to do is we want to combine everything together in such a way that we're able to really get a grasp as to why it is that I took those 5 markets. I evaluated them from the correlation study, the stability of the correlation. I created individual mini portfolios or baskets, as I call them. And what we want to do is immediately bring those together into Portfolio Maestro and create a portfolio. If you just willy-nilly go out there and just start throwing everything in the kitchen sink into a portfolio, you're going to miss the point. It's building a portfolio. You start with a market, S&P as an example, which is what this is stemmed from, and what markets will help me to diversify it and generate the best portfolio and do it in a common sense type way. So here is the equity curve, as I said, for the portfolio, and here's the drawdown for that particular portfolio. We're in the biggest drawdown at the present time, that being the the early part or May of 2012, and the drawdown is 8.59. Now, if you've been paying attention, you saw gold had a major drawdown of 24, but it only had a small allocation within the portfolio. You had some of the other markets that were able to pick up. In other words, they made more money to offset that. But we're still in a drawdown, but it's substantially better than just the drawdown associated with the S&P 500. So what I've done here is although it's not shown because this is the underwater equity curve for the portfolio, I've placed the ones for the worst drawdowns for the individual markets. You can see that the S&P and crude oil, the yellow and the gray, they both hit in around the same time period, as did the euro and the 10 years in around the 2010 period. But notice that the drawdowns, even though each of those four markets exhibited their largest drawdown at that particular time, what you would be looking at in this particular instance is virtually no drawdown whatsoever for the individual portfolio. Fast forward to where gold is having influence. There was some drawdowns that did occur, based upon some of the other markets. So we are experiencing a rough drawdown historically, but it's still only 8.5% versus the 16 to 17% that we saw for the S&P 500 by itself. But the key here is, and what really is the strength to Portfolio Maestro, is the ability to create the mini baskets, applying the different markets, or excuse me, the different strategies to that particular market, and then going through the steps of being able to mix and match those individual markets with their individual systems together within a larger portfolio. That's where what we're going to find is that there's the real strength to what Portfolio Maestro is all about. What I've done on this chart is I've added the twos. The twos represent the second largest drawdowns, and they all appear at different times on the chart. And yet, every time that they do occur, the drawdowns still are not that substantial. So you're still looking at, even with the largest drawdown or the second largest drawdown for the individual markets, combine them together, and you get a bigger portfolio. You will find that the drawdowns are just really not that substantial. They're masked, if you will, but they're masked for a purpose of putting them within the portfolio, so you get a greater opportunity to develop and construct the strongest portfolio you possibly can. So what I've done here is I've looked at the total numbers for the individual baskets, the 5 markets, S&P 10 years, gold, euro, and crude. We looked at the CAGR. I kind of went through them kind of quickly, the compounded annual growth rate for those particular markets, and they're quite high. They're quite high because I haven't dumb them down a little bit based upon some things that I can do with money management, and the margin to equities are quite high because they're individuals. But the bottom line is that when you do combine them together, I want you to note that the maximum drawdown, or excuse me, the CAGR is higher, obviously, for all for the portfolio than it is for the individual markets. But the maximum drawdown, if you compare the portfolio, against any of the other individual markets, it's less. You're doing a good job with the construction of your portfolio because of the fact that you are going through that particular process. The CalMAR, which is like a Sharpe or a Sterling type ratio, that is one that is higher for the portfolio than it is for the individual elements. So it just goes to validate and kind of prove that the portfolio itself is stronger as a whole than it is with its individual parts. So I've left a little bit of time here so I can answer some of the great questions that I'm seeing at the bottom here. But the point is, diversification, it's the name of the game. Don't be a one-trick pony. I only trade the S&P. I trade it with an individual system, a trend-based, a momentum-based, a pattern-based, but only one of them, and I only trade one time frame. What you want to do, and the strength of Portfolio Maestro, is it gives you the ability to mix and match. You might have only a single system. Well, what if that system were applied to the euro, the 10 years, or gold, or crude oil? What kind of performance numbers do you get? Well, they're not as good as the S&P 500. Well, are they good enough to trade? If you only traded that system on crude oil, could you do well? Yes, but I do better in the S&P. I asked, could you do well in crude oil? Yes, I could. So if you were to split your equity, let's call it 50-50 between S&P and crude oil, you can now go into Portfolio Maestro, compare those two, and what you're going to be looking for is not maximizing dollar amount, but what you're going to do is you're going to go through a process of trying to minimize your drawdown. So you've got risk-reward type calculations, which we're going to go into a lot more detail in the next 2 presentations. but it makes the point, why is it that you want to do this? So, well, yeah, some of the concrete, I just showed you some of the charts that came specifically from Portfolio Maestro. Uh, what we're going to look at is in the next presentation is go into Portfolio Maestro in a lot more detail and really look at all of the different types of metrics. So with Portfolio Maestro, what you can do is we can look at a lot of the same numbers that you can see at the system level, specifically inside of TradeStation. What you do is those same numbers are then applied at the portfolio level. Some make sense, therefore they will be in Portfolio Maestro. Others, they don't make so much sense because you're mixing and matching things and they don't make sense to put them at the portfolio level. So what would end up happening is that you're going to be able to combine these things together within the portfolio and really get a real honest to goodness idea as to what is going on with the building of the portfolio, why it is that you want those particular markets, as you know, I kind of described with the correlation side of the presentation, and the fact that you're going to start thinking in terms of baskets, that you build out the basket towards a single market. You evaluate that market by itself. Is it good? Is it bad? Are the systems working together and making a good mini portfolio? The answer is either a yes or a no. Then what you do is you start to take those individual markets, as I've shown in this particular presentation, and combine them together for the individual portfolio and kind of showing you a step-by-step process. I've spent an hour going through kind of the big picture because it's important that you understand that if you just simply go right to Portfolio Meister, start throwing everything in there like I'm sure most people do, you're going to miss out on the true benefit of what the program can do. If you follow a process, a methodical process of selecting the right markets, as I showed, why is it that I'm selecting those markets? It should be based upon something, hopefully that correlation analysis that I went through with you, that there's some reason why I'm doing that. Not a gut reason, a numeric reason. Then what you do is you say, this is my starting point. So now I have the markets. Now I have, and I'm not going to build the systems for you. There's plenty of TradeStation people out there that are giving away or showing you how to trade. I have my own strategies. I trade a lot of these markets. I'm simply showing you some of the systems that I use on a day-to-day basis. I'm then showing you how you can take your own systems, make them in a portfolio, evaluate that mini portfolio, look at the risk rewards and the benefits of that portfolio, and then it's a matter of combining them together. I did it in an equal weighting. What you will see in the next two presentations is how can we manipulate that weighting? How can we go through a process of showing you how to apply money management? How can I show you how to manipulate the portfolio based upon constraint analyses against the portfolio? Those are the things that we'll be getting into in the next couple of presentations. But the point is that how you go through the initial process of selecting the markets, creating the mini baskets, and the eventual portfolio, as I've shown here, that's the key to what we're doing. So with that, I'm going to give you my contact information. Um, you're welcome to email me. If you want the presentation, email me. I'll send it to you. If you want to track me on Twitter, I put out a lot of information throughout the day kind of talking about where certain markets are, where they're headed, are we long, are we short, different conditions. Everything stems from TradeStation. And when I see conditions inside of TradeStation for the markets that I track, I post the information onto Twitter. You're also welcome to link to me through LinkedIn. Some of the other questions, relate to things that I'm obviously going to be talking about in the next seminar, which is going to be next week, or the next webinar, I should say. And what we'll do is we're going to go into some screenshots specifically inside of Portfolio Maximizer, or excuse me, Portfolio Maestro. And what we'll do is we'll kind of show some of the real ins and outs of the program, more than what we did in the primer one, which was the previous webinar. And the next one, we're going to go into a little more detail and explain some of the different ratios. What's good, what's bad. I've done a number of seminars in the past where I talk about evaluating individual systems In this case, we're going to do virtually the same thing, but we're going to use the metrics that come at the portfolio level and try to get a feel for what's considered good or bad. And from that standpoint, this particular webinar, hopefully you understand why we selected the markets so that we're not just simply trying to develop a diversified portfolio, but each one applied to the S&P, Dow, and NASDAQ. The error is in the early stages. Knowing which markets to trade, that's the key. And that was the basic premise to this particular webinar. The next two, as I said, will get into a lot more detail and really show you the real benefits as to the risk and rewards and some of the charts that are obviously inside of Portfolio Maestro. So I appreciate the time and the effort. As I said, if anybody has any questions after the fact here, just email me or give me a call or communicate with me through Twitter, and we'll see if we can answer those questions. I want to thank you all very much, and we'll see you again next week.
Thank you very much, David. That was great. The next event for David will be on October 3rd at 4:30 Eastern Time. So the link is in the chat. Make sure that you take a look at that. Lots of great events coming up over the next few weeks. If you have a couple of minutes, please click on the slide and take our event survey. We would really appreciate it. Also, tomorrow is our Introduction to Easy Language. So if you really want to take TradeStation to that next level, you're going to want to attend that class tomorrow, taught by Jesus Nava. So definitely sign up for that as well. The archives for these events are going to be here. I'm going to push the link into the I'll push that link into the chat. Give me 1 second. David's first presentation, I just noticed, has not been put up yet, so that'll probably go up tomorrow. We're just waiting for our web team to post that, but it's ready to go. So here's the link for the on-demand. Lots of great on-demand stuff there as well. So save that link, and we'll see everybody at another event. Thanks, everybody, for attending. Please take our survey if you get a chance. So thank you very much. We'll see you at another event.